Hai guys, hari ini kita lagi kerjain institusi besar.
Hello everyone, my name is Zakirah and now I'm standing here to explain to you all the answer of number 1. And for the question, this. So now we look at the point of A. The data we're given is the initial cost it is 40,000 and for the growth rate it is 7% or 0.07, and for the initial investment there is 650,000 and for the required rate there is 40% or 14% or 0.14. And now we want to know should be the centenary business is started, so we need to find the PV or NPV, PV or present value. So for the formulation is PV is equal with cash flow or initial cost divided by R and D. So we have the data, we have the old data in here, so we need to write it again. So for the CV it is 40,000, so divided by divided by R is R 0.14 and minus 0.07, and after that we find is 40,000 divided by 0.07 because the 0.40 is minus 0.07 and the result is 0.07. After that we need to divide it and we have the result is 571.428. And we look at this is the PV. So after that we write in here the conclusion is PV is 571.428. Now, and it is the less from the initial investment. So because we need to compare the PV and the initial investment, if there is quite or the PV is more than initial investment, so they can start a business. But for this case, because the PV is less from the initial investment, whether the PV is 571.428 and for the initial investment it is 615,000, so it is less, so the business cannot be started. Business can start. Okay, thank you. So guys, we move to the point B. So actually the point B is explained. They not ensure to the growth rate is 7%, but they still need the required rate is 14%. So actually we know that PV is equal with initial investment. So we rewrite all of them. PV is 40,000 and divided by R and G, and for initial investment is 650,000. So because we know the required rate is 13%, so we just write it 40% and divided by 0.14 for growth and 0.5. So because they not ensure the growth rate is 7, so we need to find the other growth rate. So for this, we change this to this. 0.14 minus growth divided by 40,000 divided by 50,000. So after that, we calculate them. So we move this to here. So growth equal with 0.14. Oh no. Sorry. 0.0615 minus, because here we change it, so because it is positive, if we change to the here, it becomes the minus 0.14, and the growth is 0.0785, or we could say we change it is in percent is the 7.85. So the growth rate, if we want to the required rate is 14%. So I'll just write the conclusion here. So the company would to break even if the growth rate is here 7.85% instead wait, I think I'm wrong. Instead 7%. So yeah, we're done for the number 1.
Hi everyone, so now we're in the question number 2, and I will be solving this. My name is Salsabila, and given by the question, they already gave the complete information from the unit price until the discount rate. They also told us that they using the depreciation by marks the 7 years, and I already calculating automatically using the Excel, and here is the result. Next, onto the annual cash flow table. So before calculating the total cash flow, we have to know the OCF, which is the EBIT times the depreciation and also taxes, and also the NWC and the salvage. So now we are calculating the EBIT first by knowing the revenue, multiplying the units and price from year 1 until the 5, and here is the result. Next, onto the variable cost by multiplying the unit with the variable cost that given by the question, and here also the result. Fixed cost, it's already given by the question, while the depreciation marks is I already mentioned it before. And now we're calculating the EBIT. The formula is revenue deduct with the variable cost and also fixed cost and the depreciation cost, result in this, the year 1 until the year 5. And here is the tax. Tax is 35%. It's given by the question. We multiplying the EBIT with the 35%, and here is the result. After we complete our data here, now we move on to the OCF by adding the EBIT with the depreciation and taxes, and we got this value until the year 1 until year 5. And we have the initial NWC in 1,005,000. Also the rest is we adding the 20% because it's given by the question that the NWC will be increased every year by 20%. And also the salvage value will be adding in the last year, which is the year 5, because the salvage value is 30%, so we get the 4,200,000 by multiplying the equipment cost to the 30%. We get that number. After we complete all the number, we calculating the total cash flow, which is I got this number. Last is the NPV if the discount rate is 30%. We got here, I also do it automatically with the Excel. We got 20,500,000-ish, which is resulting in a positive value, and that means the project is acceptable. And I also calculating the IRR. It's resulting in a very high result, which is 569%, which is bigger than 30% the discount rate. That means the equipment is acceptable and it's a good investment for the company.
Hello everyone, my name is Kadek, Puspa, Komala, Dewi. Here I am. We'll be talking about solving the question. For question number 3, let's start with number 8. There's a given on this, and this is the case study. And now this is the given. We know from the case study that the annual demand is 170 cartons per year, and then it is estimated for 5 years. The equipment cost is equal to $510, and then the salvage value is $40, and for the fixed production cost is $160 per year. For the variable production cost is $8 per year, and then the NWC is $60. The tax rate is 35% or 0.35, and then the required return is 16% or 0.16. Now let's go for A first. For the A, we need to find the bid price where the project NPV is equal to 0. That means that what price per carton ensures NPV equals 0 using OFC, and thus the bid price represent a final break-even level for the project. First, let's count the total outflow. So this total outflow, we will use equipment cost. Equipment cost that is equal to 510, and then we will use the NWC that is equal to $60, and then if we combine this, we will have, we use minus 510, and then we will minus 60. That means we will get 570 for the total outflow. And then next, we will move on to the annual operating cash flow from year 1 to 5. So for the annual operating cash flow, we will use the revenue that is equal to 170. And since we are looking for the bid price, we will use bid price is equal we will bid price. We assume the bid price is P. So that means the revenue would be 170 times P. And next is variable costs. I will use as VG. VC is 170 times 8. $8. We got $1,036. And next we will have fixed costs. And that is 160. And then we will have the depreciation. For this we will calculate it. We will have 510 I mean. And then we will divide it by 5 years. Thus we will get $102. For the next one, we will talk about the EBIT. Okay, now that we already have the past things, let's move on to EBIT. So for EBIT, we will use EBIT equals to 170 P minus $1,036 minus 160 minus 102. And then after doing the calculation, we will get 170 P minus 1,622. That is for EBIT, and now we will move on to taxes. For the taxes, we got 35%. That means if we calculate it, we will have our 35% or 0.35, we will get 0.35 times the EBIT, that is 170p minus 1,622. We have the tax. Now let's move on to the net income. For net income, we will have 170 P minus 1,622. We will times that with 1 minus 0.35. Thus, we will get 0.65 times 170 P minus 1,622. Let's move on to the next one. Okay, now that we already got net income and the others on the previous things, now let's move on to the OCF, or the operating cash flow. For this, we will use OCF is equal to net income plus depreciation. Now we will get 0.65 times 170 P minus 1,622. And then we will plus with 102. If we simplify it, we will get 110.500 P minus 952.300. Okay, moving on to the next one, we will look for terminal cash flow in 5 years. Now this terminal cash flow in 5 years. For this, we will look for the salvage value. The salvage value, and that is 40,000, and then we will we will times it with tax on salvage value. That is equal to 0.35 times 40,000, and we will get 14,000. And then we will look for the after tax salvage, and that is 40,000 minus 14,000. We will get 26,000. Okay, now we also know that the NWC recovery is equal to 60,000. With this, we will count the total terminal cash flow. That is equal to 26,000. We will times it. We will plus it with 60,000. That is equal to 89,000. Now let's move on to the next one. Now that we already got the terminal cash flow, now it's time for us to find the NPV. Here we want to know NPV equals to 0. With this, we will use NPV is minus initial investment, add sigma of 5 t equal to 1 divided by OCF divided by 1 plus 5 to the power of t plus terminal cash flow divided by 1 add 5 to the power of 5. Now that is equal to 0. Okay, with that, we're gonna substitute the OCF into the NPV formula, and we will get, and substitute the all, and we will get minus 570,000 plus sigma 5 t equal 1 with 10,500 p minus 952,300 divided by 1.116 to the power of t, and we will add that with 86,000 divided by 1.16 to the power of 5 equal to 0. Now with this, we are going to use a few references for this one. That is the one where we're using PVIFA, where 1 minus 1.16 to the power of minus 5 divided by 0.16 is at least equal to 3.2743. We'll use another one. Instead of PVIA, we will use PV of the terminal cash flow, where 86,000 divided by 1.16 to the power of 5 is equal to 86,000 divided by 2.1003 is at least equal to 40.947. And next we will use that and substitute it into the NPV formula. Okay, now that we already found and simplified the PVIA and PV, we will substitute it into the NPV formula. That will made us got minus 570,000. We will times it with 110,000.500 P. That is minus by 52,952,300, and we will times that with 3.2743 and add or plus with 40.947 equal to 0. With that, we will solve P. First, we will isolate the OCF and then we will solve P. With that, we will get 110,500 P minus 952,300 times 3.2743 equals to 570,000 minus 40.947. With this, we can simplify this and we will get 529,000.053. Now we have this. We will divide all of the equation with this. And we will get 110,500 P minus 952,300 equals to 161,578. With that, if we move around the equation, we will get P is equal to 1,113,878 divided by 110,500. We will get P is equal to 10.08. With this, it means that the bid price is at the break-even point is equal to $10.08. That is all for A. Thank you, and let's move on to question B. Hello, now let's move on to the question number B, and this is the question. Now for this, mostly we will do it at the sheets and I will show you later on. But first, let's calculate it or understand the question first. So for number B, NPV at $11 per carton. The question is, what is the NPV if the price is at $11? Now, let's first calculate and understand it. For year 0, we will use the initial investment that is minus 570,000. And now, what about the other years? And thus, we will use OCF if P is equal to $11. So we will use the previous formula and just change the P, and that is $11 minus $8 times 170 minus 170,000 minus 160,000 minus 102,000 times 0.65 plus 102,000. With this, we will get 263,200, and that is for the operational cash flow. And for the discount rate, we have at 16%. And if you see the sheets right over here, this is the sheets. You can see the year 0 is minus 570 and the rest of the year is 263,200. And then next, let's move on to year 5. For year 5, year 5, we will use OCF plus the terminal value, the terminal cash flow, and thus we will get 263,200 plus 86,000. With this, we get 349,200. This is for the year 5. And next, moving on to the NPV shown on this sheet, we calculate it and then we will have 332,623. That is for the NPV if the price is at $11 per carton. Now, what is the interpretation? So, since the NPV is positive, it means that it is a profitable price for $11. And next, the bid price could still be lower than $11 and still be at break-even point or break-even for the buffer to sell fewer fewer units or observe higher costs. And thus, that is for number B. Let's move on to number C. Let's move on to the C problem. This is the question. Ta-da-dang. Now, for C, we are talking about break-even quality at $11. What is the minimum annual cartons to break even at $11? For this, I will use the quantity as Q. So first, let's look on for the OCF, where we change the 170,000 into Q. For this, we get $11 minus $8 times Q minus 160,000 minus $102,000 times 0.65 plus $102,000. And this we will get 1.95 Q minus 68,300. Now we will substitute the OCF into the NPV. With this, we got is minus 570,000 plus 1.95 Q minus 68,300 times 3.2743 plus 40.947. That all of it is equal to 0. If we calculate it, we will get that Q is equal to 170,886 cartons per year. So, if the break-even quantity is at $11, that means the quantity is at 170,886 cartons per year. Now let's move on to the question number D. Hello everyone, and now let's move on to the last question, that is number D. This is the question. And for this, it has break-even fixed costs at $11 and 170,000 cartons. What is the maximum fixed cost to break even? So let's use this OCF, the operational cash flow, where it uses fixed cost. Now with $11, we have $11 minus $8 times 170,000 minus fixed cost minus $102,000, this is in dollars, times 0.65 plus $102,000. If we simplify it, we will get, for the OCF is 433,500 minus 0.65 FC fixed cost. And we will substitute the OCF into the NPV equal to 0. So it would mean that NPV minus 570,000 plus 433,500 minus 0.65 fixed cost times 3.2743 plus 40.947 equals to 0. If we calculate it, we can get that the fixed cost is equal to 418,341 per year. This originally is higher than the original fixed cost, that is 160,000. Why? Because the higher revenue, while $11 versus 0 at $10.8 allows the higher fixed cost to be absorbed. And that is all from me. Thank you.
Okay, moving on to the last question. Here is the study case and the question. And here's the data given. So the first question that we are asked to calculate is the payback period. So the formula of payback period is initial investment or initial outlay divided by annual cash flow. Okay, so since we don't have any value given of initial outlay, so we calculate the initial outlay first by adding the plant and equipment costs plus NWC or net working capital. So the plant equipment is $15,400,000 plus $900,000. It equals to $16,300,000. So we get the initial outlay, and then now we calculate the annual cash flow. To calculate annual cash flow, we need to add the net income plus depreciation expense. And to calculate the net income, we need to deduct the total revenue minus first, we calculate the revenue from selling the clubs. By the calculation is unit sold times selling price minus variable costs. From the data given, we know that the unit sold is 50,000. The selling price is 600 minus the variable cost is 240. So we have $18 million. And then the next one is to calculate the revenue of loss selling of the high price club. With the same formula, we have 12,000 times 1,000 minus 550, and the total is $5,400,000. And then we need to calculate the revenue of additional selling of the cheap club. With the same formula, you just have to substitute all of the data given. 10,000 times 300 minus 100. It's equal to $2 million. Okay, we have the three revenue from selling the clubs, and then loss selling the clubs, and then additional selling clubs. So we add all of those income or profit, and it becomes total earning of selling and losing clubs. We have $18 million, and then plus or add with the additional selling, which is $2 million, and then we deduct with the loss selling of clubs $5,400,000, and then the total is $14,600,000. It's just the total earning from the losing clubs, and then to get the total revenue, we need to deduct these total earning from selling clubs, total earning minus the fixed cost minus depreciation. Since we don't have any information about the depreciation expense yet, so we have to calculate the depreciation expense because on the study case, we told that the depreciation is straight line depreciation. So the formula is the total cost of asset divided by their useful life. The asset useful life. So for the asset, the company only have the plant and equipment asset, which is $15,400,000 divided. Their useful life is 7 years, because on the study case we told that the project duration is 7 years, so the useful life is also 7 years. And we got the depreciation expense as $2,200,000 per year. And then we just need to substitute the total earning and fixed cost and then the depreciation expense. The total earning is $14,600,000 minus fixed cost. We also know the fixed cost from this study case is $7 million, and then the depreciation is this one, $2,200,000. So for the total revenue, we have $5,400,000. Okay, here is the total revenue. Okay, so we calculate the tax that we have to pay. So the tax is 40%. So we times 40% times the total revenue is $5,400,000. It means that the tax that we have to pay is $2,160,000. So we have to deduct the total revenue and the total cost of the tax that we have to pay. It means that the total income is $3,240,000. Okay, after we get the net income, now we calculate the cash flow. Cash flow, net income, plus depreciation, expense. Net income, we know from the previous that it's $3,240,000 plus depreciation $2,200,000. So for the expected cash flow, annual expected cash flow, we get $5,440,000 per year. So we already got the initial investment and cash flow. Now we can calculate for the payback period. The initial outlay, we know it's 16 million and $300,000 divided with the annual cash flow is $5,440,000. So we got the payback period is 2.996 years, or we just we just rounded up to 3 years. So it means that the company, the payback period is 3 years. Meanwhile, the project duration is 7 years. So the payback period is 3 years less than the project duration, that is project duration, that is 7 years. It means it's good, that's great. Because payback period, it's the time takes to recover the initial investment from the project expected cash flow. So if the company can get the initial investment in 3 years, which means less than 7 years, so it means it's good. Okay, for the second one, we are asked to calculate NPV, and the third one is IRR. So to calculate NPV, we need to calculate the PV first here. For PV equals to FV, means future value. The future value here, we use the expected cash flow from year 1 until year 7. And then FV, future value, times 1 divided 1 plus R to the power of N. The R here is rate return or cost of capital, is the same thing. And the N is number of period or year. So here in the table, this one is the calculation of PV. From year 1 and year 7, we have the same amount of expected cash flow is $5,440,000, and then divided by 1.14 because the rate of the return from the data given is 14%, means 0.14 and plus 1, so it becomes 1.14 to the power of 1 because it's year 1. And then for the year 2, we just change to the power of 1 to the power of 2, etc. until the year 7. And then we got the total PV is this one. It's 22,400,000, etc. So we have total PV, and then for NPV, the formula is total PV minus initial outlay, means that this one, the 22,442,000 minus $16,300,000. So we have the NPV. The value of NPV is $9,100,000, etc. And it because the NPV is bigger than 0, so the project is accepted because the higher NPV is more profitable and valuable the project is. After that, to calculate the IRR, we just have to use the Excel sheet with this formula. This formula equal IRR, and then we just add the year one, the year zero, which is the initial outlay, minus $16,300,000 until the year one and the year seven, and we got the IRR here. IRR is 27%, and the IRR is bigger than the cost of capital, that is 14%. So the project is accepted because, yeah, again, the IRR is bigger than cost of capital. That's it. Thank you.
Hello, and that's all from us.
Thank
Thank you.